Hello class, we're going to spend a couple minutes with an Excel spreadsheet here, kind of demonstrating how you might work out the issues with regard to deferred taxes and how they could be set up and calculated. So here's what we have: an income statement, very simple. We're going to say our revenues are $550, expenses are $45, so our income before taxes is $65,000. All right. So typically in real life, this is how deferred taxes are dealt with. You create an income statement, ignoring the tax issues to start with. That's where we are here with $65,000. Now, before we can disclose a tax expense on the income statement, we have to complete the tax return. So pause right there. Go over to our tax return, and in this first example we're going to have taxable income is exactly the same, meaning there is no difference in when the timing of the revenues or expenses. On every expense on the income statement is deductible on the tax return, and all the revenue is taxable. Everything is the same, so the taxable income will be the same as our income before taxes. Now that's almost never going to happen, but in this case, for our scenario, our purposes, we're going to make it that way. And so if that were the case, on the tax return we would have taxable income $65,000. The current corporate tax rate is 21%. We'd take 21% of that, $13,650. That would become my income tax expense. We would debit income tax expense. We would credit income taxes payable, because when we send in our tax return we need to pay that $13,650. Of course, we turn the tax return. If this was 2018, we'd be turning it in sometime during 2019. So on the financial statements, it's a debit to the expense and a credit to the payable, not cash, because you can't go back in time and pay it. You're paying it sometime in 2019. So that would be that, and then you'd have subtract the tax expense, and then you'd have net income, and then you could do your earnings per share and all the other things we've learned about. Okay, so that's how you get income tax expense in this very simple example where everything is the same. Now let's move down here and consider same numbers, except that we're going to have a single difference. So revenue, expenses, income before taxes, right? But then when we go over the tax return, we realize that there is one item of revenue on the income statement, say it's municipal interest, that is not included for tax purposes. So we're going to subtract that income over here, and we're going to change our taxable income to reflect that change, and our taxable income now becomes $45,000. Now municipal income interest is never going to be taxable. That is a permanent difference. So once we've got this, that going to change our tax calculation on the tax return, and the income tax expense is going to equal that same amount on the income statement. So we're still going to have a debit to income tax expense and a credit to income taxes payable. Now if you were to look at the effective tax rate, that is how much the income tax expense is compared to the income before taxes, you got to change this to a percentage. That's 15%. Not 21. Why? Because some of the income was not taxable. So what happens is, instead of a 21% effective rate with a permanent difference like this, you're going to have a either lower or higher. If you lower your taxable income, you're going to have a lower effective tax rate. If you increase your taxable income, you're going to have a higher effective tax rate. All right, and that is one of the disclosures that's necessary for tax purposes, for the deferred tax footnote. All right, now we're going to add another layer of complexity, a temporary difference. So here's the information with just the permanent difference we just discussed. And we have the income before taxes. We have the $20,000 municipal interest. Now we're going to consider an asset purchase. So we bought this asset for $10,000. We depreciated it for our income statement purposes over a 5-year period. So we took the 10,000, we divided by 5, we got 2,000. That 2,000 is already included in these expenses. On the tax return, we're going to take depreciation of the full 10,000. We're going to take what's called Section 179, and we're not going to get into the tax law, but under certain circumstances you can deduct the entire cost of an asset, even though it's an asset, as if it would depreciate it all in 1 year. So that's what we're going to do. Now, we might think, well, I should put the 10,000 here, but remember that this taxable income already includes the 2,000. So what I need here is the difference between what's on the income statement, the 2,000, and what's going to go on the tax return, the 10,000. Okay, so when we're doing the tax return, we're looking at, in here, we're looking at the difference. So it's going to be $8,000 reduction. Fix our formula here. And our taxable income becomes $37,000 with the additional $8,000 of depreciation on the tax return. All right, so that taxable income is $37,000, tax is $77.70. Now, when that is the case, when there is a temporary difference, you cannot just take that and put it over here under income tax expense like we did before. Okay? The tax expense is it does equal $770, but there's also another difference. You also have to deal with the tax asset or liability. So this is, you can make a journal entry for this. Debit the expense and credit the payable. Now that is very much the same as if we had no temporary difference. All right? But then we have to worry about our deferred tax liability. We have taken this depreciation in future years. What's going to happen is the income statement is going to have depreciation for that asset, but the tax return will not, because the tax return, we already depreciated the whole thing all at once. So we can't do it twice. We have to leave it off the tax return in future years. So that means that in future years, you're going to have more taxable income. That's a deferred tax liability. Future payable amounts, future amounts you're going to end up paying are a liability. So how much is the difference? Well, in the first year, it's easy to see the difference because you know that the difference is $2,000 versus $10,000, or an $8,000 amount, okay? Difference in our depreciation. The liability is the amount of the difference times the tax rate. Okay? So we're going to take 8,000 times 0.21. 1680. Our liability should be 1,680. Now, because there was no liability from previous years, we can go ahead and make a journal entry for the 1680. If there was a existing liability, we would only be looking at the change in the liability. But because there is no liability existing, we're going to make a journal entry for this. We're going to debit, okay, the expense, income tax expense, and credit the liability, deferred tax liability, not the taxes payable. That's up here. So these are two different accounts, please. We need to keep just track. This is a long-term liability. All right? So that means that that is going to be added to the expense. And now our expense is $94.50. Okay. And then your net income. And if you look at that, the effective tax rate is the same 15% as it was with just the permanent difference. So the temporary difference doesn't change the effective tax rate. It changes the balance sheet, the liability amount. Now, next year, okay, the difference will be the $2,000 going the other way. So next year, our tax return will have income, taxable income higher. If we ignore the permanent difference for a minute, that for the depreciation, you're going to you'll add $2,000 to your taxable income. And that means your deferred tax liability is going to be going down. So next year, absent any other changes, you're going to be debiting the liability and crediting the expense. That's what we call reversing the deferred tax liability. The same thing happens with assets. So the key things are you figure out the difference between your income statement and your tax return. You know your permanent versus temporary. Take each temporary difference. Figure out if it's an asset or a liability, future taxable, future deductible. Look at the difference. Treat each one of them separately as its own story, if you will. Figure out how much the difference is, multiply by the tax rate, compare to last year, and then make your journal entry. If it's a debit to the expense, you're going to add it. If it's a credit to the expense, you're going to subtract it. So that's how you operate through a deferred tax asset and liability. The practice examples are a little more complicated. Got a couple of them going at the same time, couple of temporary differences for you to practice on. But this is the way to look at them. Regardless of how many differences there are, you do it literally the same way. You just take each one separately. So you just have different line items and make a journal entry for each one.